Hey everyone, this is Dan Stous, Lead Wealth Advisor here at Flagstone Financial Management. And today I want to discuss a question that we've been getting from a lot of clients. How much cash should I hold on hand? And shouldn't I have more now because rates are so good and it's, a risk-free way to earn a decent rate compared to if rates were as low as they were a couple of years ago. Well, it's true that rates are great right now, and we like that. We like earning more on our cash than we would have otherwise. But I will say, if you have a lot of cash, tens of thousands or even hundreds of thousands, we've even seen more than that are sitting in an account that aren't earning anything. So check what rate you're getting on your cash. It's really easy to get more than 4%. I would say at a minimum 3%. But hopefully more in that 4 to 5% right now is reasonable. But going back to, how much should you have on hand? Well, think about the big picture of what the role of your dollars are. So the role of cash is typically to pay for short-term expenses. As holistic financial planners, that's at least our view. It's wise to hold cash for like an emergency fund where you have, as a rule of thumb, 3 to 6 months worth of expenses held in an emergency fund, or in your checking account to pay for the next month or so of expenses. Or if you've got a big tuition bill, or you're buying a car with cash in the next several months, or you got a home down payment, something that is going to be a big chunk of change in the next 12 months. We think it's good to have cash for that because cash is stable, right? You don't want your cash to lose or your money to lose value if you know that you're going to be using it sometime in the near future. Conversely, let's think about midterm or long-term expenses, something that's happening in 3 or 5 or 10 years. What do we want with money that's earmarked for the longer term? Well, we want at least to keep up with inflation and then hopefully to provide growth above and beyond inflation. Especially in retirement accounts, we usually rely on growth in our retirement money to pay for life in the future. So what does well at growing, at least with inflation and hopefully more? Well, historically, the stock market has provided better than inflation returns. And the bond market is kind of in between stocks and bonds when it comes to your expected return and also the expected risk. Well, I can hear you saying or thinking, yeah, that it's true that like stocks and bonds typically do better than cash, but cash is earning like 4% right now. So why put my money in a bond, let's say, that's going to earn me a hypothetical 4% rate of return when I can earn 4% or maybe 4.5% on my cash and it's not going to lose value? That's valid concern, but it's kind of short-sighted, and it ignores everything we've talked about before or up to this point, which is what's the role of those dollars? Is it to pay for short or long term? And then also it ignores kind of everything except for the current interest rate environment. So let's take a look at some data. The Fed is widely expected by economists to begin cutting rates this year due to improving inflation. Many market-based measures also suggest that Fed rate cuts could begin by the middle of this year, 2024. Now, it's true that you could get 4% or in some cases more than 5% on various cash options right now, but that isn't likely to last very long. Variable products like savings accounts or money markets are quick to reduce their interest rates when overall rates decline. And when fixed products like CDs mature, the future rates they renew at will likely be lower. You can see from this chart that, and these are just projections that often change, but the Fed funds rate is currently at 5.25%, and it's expected to be in the mid 4% range by the end of the year, and below 4% by the end of next year, and below 3% in the longer run. So yeah, rates are high right now, but that likely won't be the case in the long run, which is why cash isn't a great option for long-term savings or to help pay for long-term expenses or even intermediate-term expenses as well. Now, while long-term expectations of the Fed funds rate are below 3%, a mixture of stocks and bonds have historically done much better than that. I kind of alluded to this earlier but I didn't really give you a specific number. So this chart shows the historical risk and return profiles of various stock bond portfolios. So for instance, the all stock portfolio, which you see on the far left-hand side, has the highest return of the past 15 years at 10%. Now, we don't know it's going to be going forward, but this is just historically what the stock market and bond markets have done. Now, that all stock portfolio is also the riskiest. In any given year, you don't really know what the stock market will do, but over time, it has historically produced pretty decent returns. In fact, there hasn't been a 5-year period in the last 75 years when a 50-50 stock bond portfolio has lost money. So I'll say that again. Someone with a hypothetical 50-50 stock bond portfolio, there hasn't been a 5-year period in the last 75 years when they would have lost money. In any 1-year period, certainly they would have, because 1 year is very volatile. But if they would have held that same portfolio for 5 years, they would not have lost money during that time frame. So selecting the best stock bond allocation, whether it's 100% stocks or 20% stocks or somewhere in between, that really depends on personal characteristics and financial goals. But the point here is that stock and bond markets tend to do much better than cash. That previous chart showed nice positive numbers, but our clients know that markets can behave badly. And I mentioned you can't really count on specific returns in any given year when it comes to stocks or bonds. And this chart shows that reality. It shows the calendar year returns for stocks and bonds. While the S&P 500 has returned about 12% on average since 1990, it varies widely from year to year, returning more than 26% in 2023, really strong year, but losing more than 18% in 2022, a really weak year. And bonds have averaged about 5% since 1990. And while they're much less volatile than the stock market, you still had 2022 when bonds recorded a loss of about 13%, which was the worst in recorded history. So if stock and bond markets are so much riskier, very volatile from year to year, very unpredictable, are they really worth the risk compared to cash? Well, to answer that, let's think back to the beginning. Remember that the role of your cash is for the short term, and the role of your investments are for the midterm or the long term. Yes, that chart showed somewhat erratic performance from year to year, but here's what those returns look like in a line graph. Over time, the value of stocks and bonds tends to go up, or the return tends to grow a portfolio. So what's the general shape of these lines? Well, it's an upward slope, which is kind of what you would expect, right? Yeah, there's plenty of zigs and zags along the way, but here's the kicker. The zigs and the zags don't really matter when the money isn't for next week's expenses or next month's expenses. The job of these investments for most investors is to beat inflation plus provide some extra return in order to pay for the longer term stuff. And historically, that has worked. Now let's look at one more chart, because you might be tempted to hold your cash while rates are high and then move to a stock bond portfolio when rates aren't as appealing, let's say a year from now. Now, holding your cash for a year might get you, say, 4%, but and in a sense, you didn't lose anything. You gained 4%, right? But let's think about the concept of opportunity cost, which is what you give up in order to hold that cash. Now, in the case of holding cash, instead of investing those dollars, the opportunity cost could be significant. So here's a case study. After the global financial crisis, let's say someone who had initially invested $100,000 was invested in the global stock market the entire time. Someone else with $100,000 held on to cash for 1 year. So for 24 of the last 25 years, they've been invested in the same things except for the 1 year following the financial crisis. Today, the person who held cash for a year would have an account worth about $392,000, while the person who was invested the entire time would have $671,253. That's an opportunity cost of more than $270,000. So yes, their cash didn't lose value during that 1 year, but it ended up being a pretty costly decision. So this is kind of an extreme example because the year following the financial crisis, the stock market had a blockbuster year. But the reality is we don't know when the stock market is going to have a blockbuster year. It might be the next 12 months, or it might not be. So rather than trying to decide how much to keep in cash based on what rates are doing, keep it simple. Use cash for short-term expenses and talk to us about how you should invest the rest by using the power of the stock and the bond markets. I hope you found this to be helpful. Our goal at Flagstone is always to educate, advise, and inspire our clients. And hopefully this was a valuable piece of education for you. If you're a client and you're wondering specifically how much you should hold in cash versus invest in stock or bond markets, you know how to get a hold of us. If you're not a client and you're curious whether your financial issues or challenges or questions are things that we help people with, check us out at flagstonefm.com, where you can see the types of clients we work with, learn a little bit more about us, and learn about ways that you can get in touch with us. Thanks for watching.